Good afternoon, everybody. Uneducated Economist here. So I have talked about credible threats a million times on this channel, and I really feel like a broken record a lot of times when I bring it up again. But when I find articles talking about it almost blatantly, I gotta show it to you guys. Now, if you're new to the channel and you've never heard me talk about credible threats was, well, it's a term I've coined, but it was really came from a Ben Bernanke's speech from back in like 2001, where he talked about what the Federal Reserve can do once it has hit the lower bound. Now, they knew that they were going to run into zero interest rates. They knew that they were going to hit this point, and that monetary policy was going to become ineffective because typically the Federal Reserve would want to drop interest rates around 5% in order to stimulate the economy during a recession. This dropping of interest rates would spark people to go out there and buy, borrow money for houses and cars and going on vacation or whatnot. It would get the economy rolling again. But now that they've hit this lower bound of zero or just zero interest rates, they really can't drop the interest rates in order to stimulate the economy. They knew that this was going to happen and that they were going to have to rely on the government fiscal policy. This is where the government steps in and starts, whether they go into government projects, spending programs, stimulus checks, whatever, it's going to be up to the government to stimulate the economy, but the Federal Reserve would be there with quantitative easing in order to facilitate that trade. Now, credible threats came from Ben Bernanke, who said that we know that we're going to hit these zero bounds, this zero interest rates, this lower bound, and that this monetary policy will become ineffective, but that's okay because we can use our words. And he kind of related it down to a story of a guy who invents a gold machine. And with this gold machine, he can produce as much gold at will with very little cost or energy. And the moment that this information got out to the markets, the price of gold would plummet immediately. Even before the guy produces a single ounce of gold or has the machine built, just the credible threat alone that he can do this would be enough to change the markets or move the markets. And that's what Ben Bernanke was saying, that they could use their words in order to move the markets. And there was a perfect example of that when it came to the corporate debt. The Federal Reserve said, hey, we got a lending facility that we are going to use that we have established to use to buy corporate debt. And we are going to go into the markets and start supplying loans to this special purpose vehicle, this entity, in order to go out there and buy corporate debt. And when people heard this, they flipped out. They thought, man, the Federal Reserve is stepping into the corporate debt market. This is crazy. And a flood of people of investors started buying into this corporate debt, thinking that the Federal Reserve was going to be buying it and that they could front run the Federal Reserve. Once the market jumped in there and started buying up this corporate debt, the Federal Reserve said, hey, we really don't have to do anything. There's plenty of people out here in the market who were willing to buy the corporate debt. All we had to do was just convince them that we were going to step into the market. Once we convinced them, the market took care of itself. We really didn't have to do anything. It was simply their jawboning, their words was enough to move those markets. And that's what I feel is taking place right now. Now, I found this Yahoo article. I can't remember who authored it. I'm sorry. But it said something about like the Fed's words speak louder than actions, something to that effect. And that's the truth of the matter. The Fed really doesn't have any actions available to them anymore other than printing up money and buying the US debt. They really don't have the availability to drop interest rates to stimulate the economy. So it's all in this quantitative easing. And I feel that they are stepping up, saying that we are going to do more quantitative easing and buy into the government debt as they go into their fiscal stimulus, spending programs. And this talk really convinces the market that there's going to be a lot of inflation coming. I mean, if you think about it, the Federal Reserve is printing up this much money already and planning on printing up a bunch more. It's only a matter of time before we start seeing the price inflation really start hitting, and they can't help but to admit that it's happening. Now, I have a feeling that this whole thing is to try and set up for yield curve control, because the Federal Reserve has used yield curve control in the past. And if you're not familiar with yield curve control, they pretty much pick a spot in the maturity on the U.S. debt. So like say they'll pick out the 3-year or something like that. And they'll say, hey, we will not allow the 3-year to go any higher than a 0.5 yield. Anything above that, we will buy as much 3-year treasuries as it takes to drop the yield down back below a 0.5%. That would be yield curve control. And when they used this in the past, They really, all they had to do was to say they were going to do it, participate a little bit, and then the markets took care of the problem for them. Because once the market looked at that and said, hey, the Federal Reserve will step in every time the yield gets to 0.5%, they're going to step in and start buying these bonds. So what the market does is they try to front run the Fed, and they're like, well, if it's going to get up there, they're definitely going to buy it. So they will go in there and buy up the market before the Federal Reserve even has a chance to do it, because they know it's not going to go any higher than that, or the yield, or the prices won't drop any more than that, I guess is what I should say. That probably makes a little bit more sense. But anyway, that's what I feel the Federal Reserve is setting us up for right now by stating that they are going to do as much quantitative easing as needed in order to, facilitate the fiscal stimulus coming out of the government. Once they have established that they are going to be going into as much quantitative easing as possible, then they'll establish this yield curve control, because people will be convinced for sure that the Federal Reserve will step in to do it, but then they may not even have to do anything after that. It'll just be the credible threats. Okay. Uneducated economist, you guys let me know.